In this video, we are going to talk about analyzing the housing bubble and current inflation. So before starting this video, please like this video and subscribe to our channel for future updates. The housing bubble is a time when home prices unusually rise as a result of excessive demand, limited supply, investor speculation, and reckless expenditure. Numerous factors, such as increasing economic prosperity, low interest rates, an increase in the number of mortgage product options, and easy credit availability, contribute to these bubbles. So the main focus in this video is to analyze the housing bubble and current inflation. Let's start. Housing prices can affect residential investment and therefore affect economic growth. Rising home prices can encourage additional construction spending when the prices are high, leading to more robust economic growth. The decline in housing prices is likely to depress construction spending, leading to more anemic economic growth. Economists at the Federal Reserve Bank of Dallas found that current house price growth is most strongly correlated with rent inflation 18 months later. That means rising house prices will keep pushing current inflation measures upward. Although petrol prices receive the most of the emphasis when discussing inflation, escalating rents for housing are another factor that has raised the numbers. Due to a dearth of available homes and persistently low salaries, our affordable housing dilemma will persist even if rent increases slow down. The pandemic has seen extraordinary growth in home values. Pandemic-related market disruptions, like increased demand and rising building costs as well as other long-term supply constraints in the housing market have contributed to record increases in prices. Over the last 12 months, the Case-Shiller U.S. National Home Price Index has risen by 18.6%, the strongest year-long growth in the history of the series. Traditionally, housing markets are not as prone to bubbles as other financial markets due to the large transaction and carrying costs associated with owning a house. However, a rapid increase in the supply of credit leading to a combination of very low interest rates and a loosening of credit underwriting standards can bring borrowers into the market and fuel demand. A rise in interest rates and a tightening of credit standards can lessen demand, causing the housing bubble to burst. The association is not as strong as in our example because there are many more elements in the actual economy that influence housing values. Interest rates are another significant factor driving up home prices. Low loan rates can make home purchases more accessible and raise housing demand. The cost of homes will rise if the supply of housing is steady while the demand is rising. There is a more noticeable impact of inflation in large cities because land is frequently scarce. There is a correlation between inflation and house prices. In fact, there are correlations between inflation and the supply chain. To illustrate, consider an economy that has a money supply of only $10 and 5 identical houses in the whole economy. Each house would be priced at $2, assuming no other goods in the economy. Now, suppose the central bank decides to print more money and the money supply expands to $20. Now each house would be priced at $4. In this simplistic example, increasing the money supply causing inflation and house prices to increase. Global residential property prices have risen 60% in the past 10 years, according to a Knight Frank index. In 2020, even as COVID-19 choked the world economy, they climbed an average 5.6%, with 20% to 30% jumps in some markets. According to the International Monetary Fund (IMF), housing bubbles may be less frequent than equity bubbles, but they tend to last twice as long. Housing bubbles don't only cause a major real estate crash, but also have a significant effect on people of all classes, neighborhoods, and the overall economy. They can force people to look for ways to pay off their mortgages through different programs or may have them dig into retirement accounts to afford to live in their homes. Housing bubbles have been one of the main reasons why people end up losing their savings. Housing has a big impact on our measures of inflation. Our overall inflation index, the Consumer Price Index, CPI, is made up of several components. The Shelter Index is almost 1/3 of CPI, and around 40% of core CPI, which excludes volatile sectors like energy. There is a risk of some further acceleration in the housing components of CPI in the months ahead, both because of recent home price appreciation. The fact that the level of rental and housing prices in CPI is below its pre-pandemic trend. A renormalization would require a temporary acceleration above the pre-pandemic pace of growth. Our argument relies on a simple macroeconomic model in which banks and firms face financial constraints, meaning that the amount they can borrow depends on their current wealth. When a housing bubble appears, housing firms get wealthier and demand more bank credit. Banks cannot increase their credit supply, as the bubble does not immediately affect their wealth. Therefore, the bubble initially lowers credit to non-housing firms. So this is our today's video. If you like my video, don't forget to subscribe to my channel, or hit the bell icon. We will meet again with another interesting topic. Till then, stay safe and stay happy. Don't forget to check our important links in the description below.